Good day, colleague. Good day, students. Today we shall be looking at the second part of the traditional method of capital budgeting or appraiser. Yeah, we shall be looking at the second part of traditional method, which is the accounting rate of return, right? Accounting rate of return, unlike the one we saw earlier, the previous one was on payback period. Today we shall be looking at the accounting rate of return. Instead of we looking at estimating the or appraising an investment based on the cash inflow, you appraise it based on the profit of our accounting year. So this is a measure. This is a measure that is based on accounting profit and not cash flows. It is not based on cash flow. It is based on the accounting profit. Don't forget that our accounting profit is any profit you arrive at after deducting your depreciation and any other accounting related expenses, which we all know as what? Net profit. It uses accounting profit after charging all financial accounting expenses and depreciation. It should be noted that there are different methods of calculating ARR, that is accounting rates of return, and they give different results. One, you can either calculate depending on the question, but basically there are two. But the average method is always acceptable under examination condition, where you are not required to calculate other method. If the question is silent, it is advisable you calculate it using average capital. Now, what are the methods? Let's take it one after the other. You can calculate it based on average capital. If you are calculating based on average capital, ARR, which is accounting rate of return, equals to AAAP divided by, we said, AAP divided by average investment. That is what they are trying to say there. Where AAAP means average annual accounting profits, you have to ensure even when the question does not give you annual profits, you calculate that yourself, which we will be solving or illustrate more about that in subsequent slides. Then we have the average investment, which is AI. AI stands for average investment. That is, if you are calculating based on average, it will be average annual profit divided by average investment. This is based on average. And don't forget that average of anything is always divided by what? By 2. So average investment is normal investment, or where they call it outlay cost, or they call it initial outlay, plus the residual will give you the total investment. So the formula is total investment divided by 2. So if it's based on average. So if it's based on initial capital, it will just be profit for the year, which is profit for each year, because you have varieties of year. Profit for the year divided by the investment, which is the initial investment. Because at the average section, it is cost at the beginning, cost at the end, which is the residual, divided by 2. Okay? It should be noted that you might be asked, I've said earlier, you might be asked to solve it using different approach. There are instances where you'll be told that based on the initial capital, that you should tell it profit per annum divided by average investment. So depending on what you are asked to prepare, let's take a question. Question 1. This question belongs to Gijaniya Nigeria Limited, which is considering 2 projects, each with an initial investment of 1,000 naira, which is our outlay cost. Project A, this is a 2 project, so they want you to make comparison of which of the one with higher percentage, the one that will have the higher return, which of it should go for. So in this instance, you need to make decision. So they say project A has a life of 4 years, while project B has a life of 6 years. Okay, which of the projects will have higher return, higher accounting return? The depreciation each year for project A and B is 250 and 167 respectively. That is, they have depreciation of 250, 167. The profit realized by the project are estimated to be as follows. That is the profit for the year. Okay? The question has been presented in a table just to make it more explanatory. This is still the question. We have the earnings. Don't forget that earnings still means your return. Depreciation, we have earnings after depreciation. This is for 2 years, meaning that at the end of year 4 for project A, they made 300. Then at the end of project B, 1098. Don't forget that we say that average annual profits from the introduction class, we said it is accounting profit after charging all financial accounting expenses and depreciation. So looking at this question now, you will see that depreciation has been charged. That is why they say 50 minus 250, you have 250. 400 minus 250, you have 150. Then 300 minus 250, you have 15. 100 minus 250, you have loss of 150. Then they are having, at the end of the 4 years, they are having 300 as profit. You will see that other expenses that they have has been deducted. So there is no need of we doing any adjustments. In some questions, you will have to be the one to adjust for it. So this is cool to start with. Now, how do you determine your accounting rate of return? Using initial capital. What do we call the initial capital? We said the formula for initial capital, if you are doing it based on initial capital, if you are based on initial capital, don't forget we say that it is profit per annum divided by the investment. Now, what is the profit per annum from this question? How do you know the profit for 1 year. You know, we've been given the total profits to be 300, right? What is the profit for 1 year? For 4 years, will now be 75. So that is how you can determine your profit. If you are calculating it based on initial capital, profits per annum, profit per year equals to 300 divided by year is 4 years, which is A. A own is 4 years, right? That is how you can arrive at your profit for each year. 300 divided by 4, that's around 75. That's around 75 per annum as computed here. So without wasting much time, you will see that we are still in line with their calculation. So project A is 300 divided by 4 years, which is profit for 1 year, which is per annum. You can actually call that average profit based on initial capital. Average profit based on initial capital is based on the total years, depending on how you understand it. Average profit based on initial capital is based on what? Total years. So they did the same thing for project B. That is how they arrive at 183 naira. Then what is our initial investment? Go back to the question and read. Oh, cool. We have our initial investment of 1,000, right? Meaning that the initial investment is for both projects. And what do we call the formula? We say it is profit per annum, which is average profit based on initial capital divided by what? The initial investment, as stated here. Can you see? As stated here. Okay. So they had project A as when you divide 75 by 1,000, you have 7.5 and 18.3 in percentage because it's a rate. So you put the rate in percentage. So this is how you can determine your accounting rate of return using what? Initial capital. But the question said that we should calculate for initial capital and calculate for what? Average capital. And don't forget that average capital owned is divided by what? By 2, not dividing the profit by the numbers of years. Let's take that. If you're calculating based on average capital, your ARR, don't forget that average capital based on average, we gave the formula to be what? Average annual accounting profits divided by what? Average investment. And average accounting profit is divided by 2. Average investment, and our average investment is initial capital plus residual divided by 2. It has been stated there. So let's take solution. You can always flip back to go and check the formula. Now we have our profit, average profit. We have our average profit. The ideal thing is that different methods can be used in solving this. Now, we already have our average profit here. we've solved our average profit in the previous slide to be what? 75 per annum, right? So let's now determine our average investment. Don't forget we said that initial investment plus residual. Is there any residual in the question? Obviously no residual in this question. So you go there and put 0. Don't forget we say our average investment, the average capital is average investment. This is average investment, right? That's why they say 1000 plus 0, which is the residual. Since we don't have residual, you replace it by 0. Divided by 2, you have 500 as average investment, right? So the next you do is to calculate the average accounting rate of return based on average capital. Our average profit has been computed here to be 75 and 183. Just the investment will change. So we have our 75 for project A, and we have 183 for project B. A division of both, you have over the 500 that was the investment, the average investment, you have 15% and 37% approximately. So how do you now make your decision? The decision will be that which of the projects should be embarked on, which of the project has higher return. Using the first method, which is initial capital, what is the percentage we have there? 7.5 and 18.3. We have 7.5 and 18.3. Then using the other method, average capital, we have, using average capital, we have 15% and 37%, right? You will see that if you want to make a decision like this now, using initial capital, you can say that project B should be what? Should be embarked on. Using what? Initial capital. In any of the cases, if you are making a decision based on average capital, which of them has the highest percentage of return? Is still project B. This means that in all cases, project B should be what? Should be selected before selecting project A. Because of what? It has the highest rate of return. So that is just the decision, right? That is just the decision. So let's take another example of this nature. Let's take another example. This might just require you doing some little workings. Now, example 2. Example 2, Premium Part Limited is considering the purchase of new machine, which is expected to save labor on an existing project. The cash flow associated with the project are as follows. So these are the cash flow in thousands, please. You can see the 30 at the top. So initial cost for year 0 is 120,000. Residual value of the machine, which is the at the end of the year cost at year 5, 20. Annual labor cost savings, which is the return that they have. Don't forget that savings is also known as what? Returns. Right, don't forget that. Year 1, we have return of 40. Year year 2, 40, 40, 20, 20. We are now told to calculate this is regarded as cash inflow. Please take note of that. Cash inflow. You can call this savings the cash inflow, or you call it the return. Let's just do some little adjustment. Don't forget that the profit we always use under accounting rate of return is always the profit afterwards charging all accounting profits and depreciation. Don't forget that. It's very, very important. Now, we've been given the cash inflow, right, which is the return, the earnings we went to go and save somewhere. Now, this savings, right, it is after all necessary returns that is expected on that project must have taken place. That is why we arrive at this amount that was saved. 40,000 was saved as year 1. Then you save 40 again. You save 40, right? Okay. So let's calculate the return, accounting rate of return. Here we shall be basing it on average only. This we shall be basing it on what? Average only, right? If you are basing it on average, if you are basing it on average, it will be the usual way we've been calculating. But let's take some adjustments first. Now, what is the total profit, which is the savings? Don't forget that this savings, depreciation has not yet taken place. Depreciation has not yet taken place. If you take a look at these questions very well, you will see that from the savings that we have year 1, for year 1 to 5, if you take your calculator, punch your calculator, 40 in 4 places, in 3 places, plus another 40, you have what? 160. Right? You will see that the total profit that they have before any distribution take place is 160. But the profit we always need is what? The profit we always need is the profit after all accounting profit expenses have been charged and depreciation. Are you getting me? So total depreciation, which is outlay. What's the total depreciation? Depreciation for 5 years. Don't forget that we've been given the scrap value. Let's go back to our elementary class. Don't forget that in our elementary class, we say that cost minus scrap value divided by what? The years, the useful life, divided by years, right? We have depreciation for what? For each year. Now, cost is how much? 120 right? Cost is what? 120. 120 minus what? 20. We give you the depreciation for the whole year. Divided by what? How many years do they have there? They have 4 years. Right? The accounting depreciation is 120 minus 20, which is 100. Is depreciation, total depreciation. If you divide it by 4, you have depreciation for each year. And don't forget here, we always deal with total accounting profit, not accounting profit for each year. Why we cannot calculate for each year is that the total return, we sum everything together. Okay? We sum everything together to be that, to be 160. If you now want to determine the depreciation for the whole 4 years, depreciation for the whole 4 years will be what? 100, which is for 4 years. When you divide it by 4, you have depreciation for each year. Not to waste our time, because we've already summed the 160, which is all returns. You should have just been doing 25, 25, 25, 25, 25, 25, 25 minus 40 minus 25, right? That's 3. Then we have loss in the other way around. Okay, so the next we do is that since we've arrived at our depreciation for each year, depreciation for the whole 4 years that we need, so just deduct depreciation from the profits that we have. Divided by the profits that we have. If you divide it by the profits that we have, you will see that we are moving forward to the direction very well. Now we've arrived at our depreciation for the 4 years, which is 100. Looking at the calculation here, we see that they have what? They have 100 as well. So deduct the depreciation from the profits, which is 160 savings that was made before depreciation, right? Because depreciation has not yet been deducted. If depreciation has been deducted, you will see that we will not have this scrap value. They will have tell us that, okay, oh, this is earnings, this is depreciation, oh, this is the one after depreciation, as we have it in our previous question. But here we are not told. What do? You need to calculate it just logically. So when you deduct the total savings from the depreciation, which is 100, you have 60 as the accounting profit. 60 as the what? As the accounting profit. So since we have 60 as the accounting profit, don't forget it's in thousands because we've already put 30 at the top. So meaning that the average of that profit, which is the profit for 1 year, average profit will now be that 60,000 divided by what? By 5, because we are calculating based on average, don't forget. So we've arrived at our Divided by 5, you have 12,000. Then average investment outlay cost. It is obvious. Just look at it sef. You will see that depreciation is there. At year 1 is 120. At the end of 5 years, that is at year 0, when anything has not yet happened to that asset, is 120. Then when the asset is at 5 years, is 20. How about? It is very, very obvious that depreciation has taken place, meaning that the asset has depreciated, the residual value, meaning the scrap value at the end of the year. So it means that the depreciation has taken place. At the depreciation has not yet taken place, then we should still have 120. At that hence, we will know that there is no depreciation in this savings. But here we see that there is depreciation in the savings, right? So what you just need to do is that deduct depreciation from the total savings so that you can arrive at the profit after depreciation. So next is that you calculate the average of that profit, because it's not total you have to post. Don't forget the formula for accounting rate of return based on average is average annual profit, because this is the profit for each year now. That's why I say annual profit for each year, the average of it. So divided by numbers of years, which is the profit per annum. Divided by what? Average investment. So what did I call our average investment? We said the initial outlay, which is the cost, initial cost or outlay cost, plus what? Residual divided by 2. Residual means the scrap value. So we have initial cost to be 120 plus residual 20 divided by 2. We have 70,000. Then our ARR will now be average annual profit, which is 12,000, divided by average investment, which is 70,000, times 100 over arm, we have 17.14%. We have 17.14%. Right? That is just how to determine all this. Just know that work your way back to what? The total profits, deduct the depreciation if any, or you compare the scrap value and the initial cost so that you can know the depreciation in that inflow that has taken place. Similarly, you can look at this. You will see that initial investment is 1,000, right? Initial investment is 1,000. Which one do you use? They've told us straight here. The inflow, which is the savings, depreciation, they've assisted us in calculating it in this question. If you look at this table, you see that they've assisted us in calculating, right? But here, it is a raw question where you need to draft out the depreciation yourself. And depreciation is cost minus scrap value. It is obvious, 120, 20 at the end. You see that, meaning there is a difference of 100. That means that difference is the depreciation. Very straightforward. So practice more questions and assignments will be posted on the platform. You can keep watching over and over and ask questions where you need more clarification. Thank you.